Morning everybody. Thank you for coming today. I'm Kerry Underhill, Head of Communications here at Fonterra. I have with me today our Chairman, John Wilson, our CEO, Teo Sperrings, and our new CFO, Lucas Paravicini. We're here to talk about our full year results, which we announced earlier this morning. I'd like to now hand over to the Chairman. John.
Thank you, Kerry, and a very warm welcome to everybody that's here. And I'd also like to, as Kerry's just said, extend a very warm welcome to Lucas, who has joined the management team of our cooperative. Look, first of all, I'll just cover off our announcement that we made last night. So last night we announced that we had lifted our milk price to our farmers by 50 cents, a significant lift up to $8.30, which is just great news for our farmers and frankly for this country. We've also held the dividend announcement at this stage, forecast dividend. It is very early in the season, that's staying at 32 cents. So that's a total lift for our forecast cash payout to 100% shared up farmer for the season we're in now of $8.62. Teo will probably touch on this later on, but the reality is that it's still very early in the season. It is a reflection of the volatility that we've got right now. Certainly $8.30 is our equal upside, equal downside view going forward, and we'll continue to update that as we proceed through the year. And Teo will talk about the reality of, with those high milk prices, the impact that that has on our earnings in the short term, but we will cover that off later on, but we're still forecasting at this stage that 32 cent dividend. So to the 2012-2013 year that we're in, just completed. So we have today, after yesterday's board meeting, been able to announce this morning a final farm gate milk price for the year that we've just completed of $5.84 and a final dividend of 32 cents, which gives us $6.16 return to 100% shared up farmer. That is based on a net profit for the year of $736 million, which equates to a earnings per share of 44 cents. So, you know, a very strong result for the year that we have just completed. And pleasingly for our cooperative, we've got a balance sheet of 39.6, so just under 40% debt to debt plus equity. And that is after we supported our farmers through the drought of last year with advance rates brought forward. So we're seeing the cooperative operating very well for our farmers. Next slide is just really a reflection of the movement over the last years. So $5.84, not a huge number for our farmers in the context of the last 4 or 5 years, but I think it's important to reflect on the last 12 months. This time last year, we were selling milk powder at $2,600 a tonne. So if you see the result where we've got to, we actually started at a $5.50 advance to our farmers. It dropped to $5.25, and we've been able to complete at $5.84 plus the earnings figure of 32 cents. It's just worth reflecting on that drought. It is the reality of farming. It is the reality for our cooperative. You know, that second half of the year, that impact of the drought, that was 9% down on the previous year, which is just a dramatic number. That meant that the final number of 1.463 billion kilograms of milk solids was 2% down on the prior year. Just want to finally touch on our capital structure and the impact that trading amongst farmers has had. Now, we had a significant discussion for 3 or 4 years in our cooperative as to moving to what we call trading amongst farmers and having permanent capital on the balance sheet of our cooperative. We've been able to see since the launch, which was very successful at 30th of November last year, we've really seen that decision that we made in moving to trading amongst farmers come through so successfully. Significant drought in the second half of the year would normally have seen a significant amount of capital actually leave the balance sheet of our cooperative, and of course that did not occur. On top of that, we've been able to add far more flexibility for our farmers and how they operate within our cooperative than we've ever been able to have before, and you will see more of that as we go forward over the next 12 to 24 months. Had a bonus issue, a 1 to 40 bonus issue, which in effect is really another 17 cents a kilogram of milk solids that's available to our farmers if they decide to sell that share. And lastly, a very successful supply offer where 20% of our farmers were able to participate, again adding far more flexibility to our farmers' businesses as well as to Fonterra. So all in all, we're very happy with how the capital structure is working. It's certainly made a big difference to our farmers' businesses, and it's put a lot more stability into Fonterra and the way that we can set about executing strategy and deal with volatility in our business. And probably a good time there to hand over to you, Teo, and take us through the business.
Thank you, John. Going through the business on the first slide, you know that we have a V3 strategy, so we focus on volume and value. On the volume side, I would like to start saying that, of course, 4 million metric tons, that's 4 billion kilos of product sold. That is massive. What John just showed in our curve, and especially the autumn where we were facing the drought, that was roughly 400,000 tons of milk powder. So let's say if we would have had a normal autumn, then that number would have been 4.4. So it has quite a significant impact on our volume. I will come back to you in the strategy part on turning the wheel. For us, it's very much how can we shift volume from commodities into higher value propositions. And what you see here in the overview is that good news really is that Asia, Africa, Middle East, after years of growth of around 2-3% maximum, we are really turning the wheel. Yeah? We are going to double-digit growth, and that's really in line or above market growth, so we are gaining share. Yeah, that 11% is very good news. New Zealand milk only 1%, but like I said, if we would have had that 400,000 tons, which we didn't get because of the drought, then that number would have been significantly higher, possibly 5-6%. Latin America, same story. We're coming from 2-3% volume growth up to 6%. So we're really in the emerging markets, we're stepping up our game and we're growing faster than market in those geographies. And that means gaining market share, which is good. Australia and New Zealand down 2%. I want to split New Zealand and Australia all the time because New Zealand has done extremely well. Volume growth and value growth. Our issues, as you know, is in Australia. I will come back to that. It's not new, but we are reviewing and reshaping the business as we speak. On the value side, 736 million of NPAT. That's up 18%, but to be fair to you, I mean, we did very well in the field of financing, so we had a 40 million lower interest charge than last year. So that's good work of the financial team. But we also had a 60 million tax upside. So if you like, there's 100 million interest and tax upside, and that's why you see that number on 18% plus. That 18% translates into normalized earnings per share of 47. You will see 44 as well. Why is that difference there? Because we did the bonus issue that John spoke about. That means more shares, right? And more shares with an NPAT number, that means 44 cents earnings per share. But if you would do it on a constant number of shares, it's 47. So that's more like for like. And EBIT 1 billion, we have announced that already a few months ago. That was our latest forecast, so that should not be a surprise. Then New Zealand milk, I'm going into the units. New Zealand milk, very clearly a very strong first half and a very, very tough second half. You see that 72 number. Just to put New Zealand milk in perspective, what the drought did. Yeah, of course, 400,000 metric tons of products. Then only on domestic milk, so that's DIRA milk and our contracts with the domestic players, plus what we call stream returns, or call it product mix, because the whole portfolio changed around from whole milk powder being the worst in the beginning of the season to being the best. So that turned completely around. That's an impact of 200 million. Yeah, so that's really massive. And then we have another 100 million, which is really what I said on all the local milk, DIRA related. So If we would have had a normal year with normal volumes, the stream returns would have been on a stable basis, and that was our forecast as well. This number would have been 200 to 300 million higher. Volume I've touched upon, plus 1%. That's in my context low. If you would have had a normal autumn, it would have been much higher. Going to the next slide, Australia and New Zealand. Again, what I said, New Zealand good. Australia under pressure, and we are reshaping that business. It's fair to say that we found our feet here. We are really reshaping in terms of numbers of brands, complexity. We have taken 49, you will find it in the annual report, 49 million of cost out. But when you take cost out, you have also cost up front. So we took a lot of pain. People are sometimes very negative about it. I think if in this context, harsh environment, high milk prices, tough retailers, if we still make 142 million, there's still a good profit number. But it has to be better in the future. So the next page you really see why I've always been talking about on the left-hand side, tough retailers. Yeah, in the green box, very aggressive suppliers, especially in the Australian context, who set the milk price very high, and the processors in the middle. So you have to make sure that your value chain is efficient, lean, otherwise you don't have a ticket to the game. Yeah, and what we did last year is that we earned our ticket to the game. What did we do? Less brands. You see the key brands underneath. We have 21 brands. We focus on 4 right now. So there's 17 less. Yeah, so there's Mainland, Perfect Italiano, Biga, Western Star. We really want to drive everyday nutrition. So we are in good talks with retail on everyday nutrition. The nutritionals out of Darnham and Dennington, although Darnham after last event, we have to kind of regroup, but we are still committed to nutritionals. Foodservice is a great business with good profits, so we go harder on that. And like I said, take out cost, take out complexity. That's the name of the game. And again, I've said before, I come from a European environment. Lucas comes from a European environment. This retail scene and pressure we are used to for the last 20 years, and I'm telling our people that it's not going to get easier. This pressure will remain to be there, so we better have an act together. Then the next slide on the emerging markets, where we really committed. That's where you see the very good news. 11% volume growth, very, very good. And even the value growth, considering that the second half, of course, milk prices were up. So cost of goods sold was up. And we still have shown a very good result, driven by key countries like Indonesia, Malaysia, Vietnam, and China. And those are the countries we want to be in, because we have #1 positions in Chile, in Sri Lanka, and at home, New Zealand, Australia, but that's less than 100 million people. We need to go to the markets where we have high numbers of people and where the middle class is growing fast. So this is a key slide and a key achievement for our future. Latin America, another emerging markets, Soprole, who have been doing well year on year. They've really shown strong volume growth and value growth. In the context of DPA, that's our joint venture with Nestlé, we struggle a little bit. We see in the right bottom corner 19 million upside last year. If you would put that into the equation, then the result is kind of similar. But we definitely have to align our strategies as joint venture partners and define our way forward. But Latin America, promising results and a key emerging market geography for us. Moving to the balance sheet, very good and a game changer in working capital. We've reduced 8 days. 1 day is about 60 to 65 million, so this is 500 million less working capital, so better balance sheet. And on the right-hand side, you see that we use that money in the drought. Yeah, that's the dotted box, to step up our advance rate to farmers, to make sure that after the drought they were able to prepare for the next season and start the next season, this season, 2014, that they could start it off very strongly. So like for like, our operating cash flow, operating and investing cash flow was similar to 2011, which was an outstanding year. So we had an outstanding year, but we used it really to strengthen the position of our farmers. That resulted, people are saying, even around the announcement of yesterday, that we talk about strong balance sheet and that we support advance rate last year and possibly dividend this year. We will only do that when we have a good view on the gearing numbers, and you see that even with the big reach out to farmers, our gearing is still stable, and our policy is 45 to 50%, so we're well below that. On the bottom, you see the right bottom side, you see 925 million of capital expenditure. Darfield was a big chunk of that, so a lot has been invested, almost 600 million in New Zealand, the rest offshore. China Farms was a big part of that. We are talking in the season, which is coming in now with high milk prices, some pressure on margins. We have to focus on cash flow, so we're really looking at the coming year on our tight view on capex and cash flow. So that's the results in a nutshell. You do have the pack, you do have the annual review. So happy to go into Q&A afterwards. A quick update on strategy. You're used to that in the meantime, I hope, that we revisit strategy every 6 months with you, where we are. We are even more committed to our 6 trends where we want to tap into. Of course, we come out of an event, a WBC 80 event, but we are just back from China, so the left top corner, emerging markets, cities, the need for protein is massive. You see our GDT results. There's a huge demand for our products, and especially from the Asian context. So protein into emerging markets is key, and that's the baseline business for us. Volatility, again, when you look at the announcement of yesterday, on one hand for the farmers, of course, fantastic. For New Zealand, fantastic. It's billions flowing into the economy. But it puts, for a certain time, it puts pressure on your P&L, and we have to cope with that. It's a matter of time. We don't know how long this will take, this high volatility, and a big difference between milk powder and other milk products, which is unusual. I've never seen that before, but that's happening right now. We have to deal with that volatility, and what John is always saying, volatility is our friend, and definitely is the big friend of farmers and the New Zealand economy at the moment. Nutrition, you know, I'm very much focused not on dairy, but on nutrition, because that's what we sell to consumers. Nutrition for the young, very, very key platform, and aging population, crucial, so we committed to that and even drive harder. Sustainability at home, we're working on the sustainable growth plan for New Zealand for the coming 10 years. So all this on the screen, and really we're driving hard. When you go through an event like our last event, you have to be honest with yourself. You have to say, what am I going to drive harder after this event? Where do I slow down? And possibly what do I put in hibernation or in a freezer, as I call it? There's certainly things which we have said we will stop putting resources on that right now for the coming 6 to 9 months. But there's also things where we go much faster. So going platform by platform very quickly, we're very committed to New Zealand milk. Next to the investments, we have to be world-class in quality and food safety. We very much have that. People out in the markets, they very much rate us that we blew the whistle on ourselves and ended up with a false positive. But this never waste a crisis, lift the bar now on food safety and quality. In Everyday Nutrition, key platform, we have to get Australia right. We have to get DPA right, our joint venture with Nestlé. Remember, I've said to you before, we come from 69 brands in this platform, 69 brands, and we're going back to 11. Yeah, so there's quite a big reduction of complexity. Foodservice is our jewel, the really fantastic business model. We have grown almost double-digit numbers in volume terms, and we have a strategy in place that we want to grow this platform 20% volume growth year on year. And that's why you see investments like Waitoa, Terapa, and we have approved yesterday in the board meeting another investment into Clannyboy, all for food service and really to go harder on volume. Because we like Darfield, but we prefer to build stainless steel for food service, which brings much more value. In the lean proposition, we are saying we're not going to new countries. So that's, if you like, that's where we slow down a bit. We're not going to new geographies. We're committed to the positions where we are. And lean has to be our brand for healthy aging. So we are refocusing on our brand from bone health to healthy aging. In the maternal situation, lots of opportunities. The third-party manufacturing, especially for Chinese customers, is a big opportunity. And you see here that we go to new geographies. As we speak, we'll launch in China and Hong Kong. And we are thinking even of a next new geography where we will be present with infant nutrition ourselves. You read only a few weeks ago, big commitment again on China farms. Second hub, big investment. Part of the board has seen where we are going to build that hub. The 2 hubs will be minimum 300 million liters of Chinese milk, and we will continue to build that milk pool till 1 billion. On the organization support review, we almost forgot about that, but that was the 300 people and 65 million cost savings completed. Australia right sizing, we're coming to an end and really finding our feet and building from there. And we need a lot of resources in China at the moment for our growth strategy. That's a strategy, so nothing new, but some areas where we really re-emphasize and want to go harder. Strategy into action is the wheel. Turning the wheel for me. If you see the right top corner, that's global dairy trade. There's 400,000 tons of powder there where we can and should create higher value. That has to move into long-term supply agreements and into pediatrics, food service, and all the way up to consumer brands. Right? That's the name of the game. And you see with our growth in emerging markets, which is very much in food service and consumer brands, that's where we are growing fastest, so we are turning the wheel. Out of going to the different segments of the wheel, everyday nutrition, how did we come from 69 brands back to the core? We first said, what is everyday nutrition for us? Everyday nutrition is craftsmanship in cheese. That has to be globally under the flag of mainland. The Italian cuisine, taste enhancement, that's retail and food service brand. That's Perfect Italiano. That's a fantastic brand with a potential global reach. The dairy expert, that's everyday nutrition on your breakfast table every morning. White milk, yogurt, feta, sour cream, all the stuff we use. That's Anchor, Fernleaf, Soprole. We only focus on these 3. And everyday affordable nutrition is Biga and Rati in Sri Lanka. So these are the brands remaining. We have taken pain. You can see that in the annual report last year for an impairment of the other brands. Food service is a 1.3 billion business. I'm not going to dwell on it. I've said enough about it. We're committed. We're investing heavily behind it. We do have a very competitive in-market model. We're very successful. So if you're successful, drive your strength even harder. Advanced nutrition I've spoken about. And lean, focus on healthy aging. Try to move from bone health to healthy aging and widen the scope. And in NMAM, very committed to our selected geographies, but we won't go far outside of these geographies. So what that will result in is the next slide. So it's in fact very simple. When you look at the horizontal axis, that's where you see capital. The big bubble there is, for example, Darfield. Yeah, a lot of capital, but not a lot of milk as well. That's why the bubble is big, but not very high value. So what we want to do is reduce that bubble over time and grow everyday nutrition, food service, and advanced nutrition. Of course, branded business does not only require capital, but also requires A&P. So there's definitely more cost to this business than only capital. But this is what we're really driving. Yeah, so it's the nutritional platforms, reduction of the big bubble, and increase the smaller bubbles over time. So where are we in terms of outlook? I think you've read it all in the press release of yesterday. Like John is saying, a record. It looks like we're going for a record year, and there's not a lot of doubt in our mind at the moment already, which is strange in the second month of the year. But that we're kind of going for a record year in terms of payout. That's very good news. We need some good news after the sailing of this morning, I guess. Let's focus on tomorrow. Headwinds for us, I've touched upon that in a few buckets. So that's really our cost of goods sold for brands is going up because the milk price is higher, and our product mix is not very much in favor for the non-milk price products. So that goes to EBIT. So there will be significant pressure on our EBIT line. And like I said, for New Zealand milk, in half a year we had a turnaround in that bucket of 200 million, right? But yeah, things are we are living in a highly volatile environment, so we have to see what's going to happen. So the first half will be definitely lower than the first half of last year. Second half for consumer branded goods looks good. For New Zealand milk and commodities, it's too early to make a statement. We would like to keep our dividend unchanged. We have a strong balance sheet. You saw our gearing number last year. Farmers had pressure because of the drought. We stepped up, we helped. This year, yeah, there's pressure in the P&L. We want to look at all our shareholders. We keep it unchanged, but that requires from Lucas and myself that we focus very much on cost and cash and capital expenditure, because we need to have the cash to support a dividend stream. And like you heard me talking today, we are and we will be extremely committed to our long-term strategy. So yes, short-term volatility. Short-term, we just come out of an event, very big volatility, but we always keep a long-term view. We just come from shareholder council. Farmers always take a long-term view, and that's why it is a pleasure to work for a co-op.